Welcome back everybody to Click Capital, your go-to channel for all the latest market data analysis and charts. And stick with me today through to the end of this video and I'll let you know why I've started to get a bit net short on this market again, as I think this rally we've had for over a month now is starting to run out of steam. So it was a pretty mixed day out there on the markets. Overall red, we did see those good bank earnings coming in. JP Morgan actually popped up 7.5%. However, mega cap tech came off a bit, NVDA was up a little bit, and we did see REITs sell off, along with healthcare and a few other defensive sectors like utilities and consumer defensive. And in another sign that the consumer may be getting weaker, we saw retail sales come in today a lot lower than expected, declining 1% month over month, which was lower than the 0.4% that we expected. Fear and greed index is still elevated up here at 68, and that's at a level that is associated with short-term market tops. Dark pool index still at 47%, sitting around neutral territory, and they've lost interest over this market rally from the last couple of weeks. Corporate insiders haven't been buying this rally either, pretty record lows down here for their activity. Option market was busy today as it typically is on Friday. We did 40 million contracts and still more calls, 53% calls, and on mega cap tech as well. Except for NVIDIA, that we're still seeing higher put percentages in at 53. Meta came in at 37, Amazon 36, Apple 48, and Microsoft only 41% put, so still more people buying calls in those mega cap tech names, which I think could be a contrarian signal. And after we saw those positive bank earnings come out today, the bonds market has actually priced in a higher chance of a rate hike at the next Fed meeting. Yesterday it was 69%, today's 78% chance we get that 25 basis point hike on May 3. So it looks like the banking woes may have really subsided and is just limited to the smaller regional banks. And fears of contagion appear to have all but faded away, and we can see that in the VIX index as well, which I'll get to a bit later on the charts. And we had been waiting on Warren Buffett to see what he's saying about the banks, and people were hoping for him to potentially step in with an investment. During the peak of the crisis a month ago, we did see those private jets fly into Omaha and assumedly trying to get a deal out of Buffett, but that didn't happen. He actually says we're not through with bank failures, but depositors should not ever be worried. So he had already been decreasing his allocations to the banking sector because he didn't like what was going on there. But he's not worried about any systemic problem, and him as a big bank stock owner, as well as the bank CEOs, of course, are not going to add fuel to the fire and try and increase more fear out there, so they'll always try and talk it down. However, interesting to note, he hasn't been buying banks throughout all this mess. And I pasted in a lot of what Buffett said into ChatGPT and asked it to summarize for me. And basically, he just said that there's been bad actors and they've been doing questionable accounting practices designed to manipulate earnings. And he said CEOs should pay for the actions if they cause banks to failure. And he's already been noticing this behavior, and that's why he's been selling his bank stocks over the last couple of years. But he's confident that no depositors will ever lose money. The government will backstop it. And here's a quick look at Buffett's portfolio. Still has almost 39% in Apple. Second biggest holdings, Bank of America at 11%, and he also has American Express at 7.5%. But these are long-term holdings in his portfolio, and it doesn't look like he has been adding to the banks. Instead, just been criticizing them. We also had BlackRock's earnings out today, and I asked ChatGPT to summarize what the CEO Larry Fink said, and basically said US may not face a significant economic downturn this year, but inflation will persist. He doesn't see a big recession, at least not until early 24, and the possibility of recession depends on the Fed's battle against it. And inflation is likely to stick around longer with a 4-ish floor, and that his clients are increasingly considering reducing risk in their portfolio by having a better foundation of bonds and equities. So again, a guy like Larry Fink's not going to stoke the fears of recession out there, and is trying to shift all the responsibility onto the Fed for it. But I'll get more into BlackRock's earnings on the charts. I also did the same for JP Morgan CEO Jamie Dimon. He warned investors and businesses to be prepared for higher interest rates to persist for a longer period than expected by the market. He believes this scenario will highlight problems in the economy for those who have exposure to floating rates or refinancing risk, like the commercial real estate sector does. And he noted the recent regional banking crisis has fueled bets that an economic slowdown would force the Fed to pivot and cut rates later this year. And he advised all clients to prepare for the risk of higher rates. And to sum up the biggest banks reporting today, JP Morgan, Wells, Citigroup, PNC reported a surge in net income and revenue in Q1 of 23 compared to the same period last year. Despite a decline in deposits and an outflow of customers to money market funds, the bank's size and diversity as well as their ability to maintain buffers to absorb losses and liquidity, have made them more resilient than smaller banks during times of uncertainty. JP Morgan and Wells benefited from the rise in interest rates, which allowed them to charge more for their loans, but they predict that net interest income will come down significantly next year. Despite the challenges, the banks are not anticipating any changes in their lending policies. So these big banks have really benefited from what's happening actually. Since there's been a flight of deposits from regional banks, the big banks can offer a lower savings rate and still attract more deposits, as they have been, in a way of kind of making their customers pay a premium for the safety of having their deposits with them. And on the other hand, they can charge more for their loans as well. So basically, being so big and being way too big to fail, there is allowing them to earn a premium that the smaller regional banks just can't. And we're seeing that in the price action on the charts as well. So that's an interesting dynamic in the banking sector. And Best Buy is laying off hundreds of store employees as they change their business model to be a bit more online. And they've seen the consumer pull back in things like consumer electronics and other discretionary items. So with the rise in inflation, consumers are spending more on necessities. Okay, that's it for data today. Let's head on over to the charts. Okay, so we've got the SP500 at 41.37 and stalling out in this resistance zone on a bit of a spinning doji here. But I'll come back to this at the end of this video like I always do and let you know how I'm positioned going into next week. Just quickly looking at international stock indices, they appear to be stalling out a little bit as well, consolidating up here. It's the FTSE, the German DAX, Japanese Nikkei at the top of its range now, the Aussie 200 consolidating, and China back below its 50 as well. And just look at volatility. Look at volatility 9-day at a 13 handle. That is so low. And the VIX at a 17. And the VIX now at a low 17, coming right down to the support zone. I'll just go out to a weekly chart for you. Apart from briefly touching this in late January, we haven't been down here on the VIX since before the start of the bear market early last year. So option premium has been absolutely crushed in this market, as it looks like option dealers are pricing in with April seasonality. And I suspect this has a lot to do with the banking crisis as well. We can see here we actually spiked to 30 when Silicon Valley Bank failed. And ever since that, things have kind of calmed down. And with JP Morgan ripping 7% higher today and saying everything's all good, the volatility of this market's just completely disappeared. However, if you look back in history, when the VIX dips this low, it can be a good time to add hedges and even look at trimming your long exposure, as typically the opposite is true as well. When VIX spikes, typically a good time to get long. But I'll get more into that at the end of this video. Actual volatility really low here at a 14 handle on realized volatility. And bond market volatility has really come off as well, now at 118 on the MOVE index. However, we still have a premium of the MOVE index over the VIX. And the bond market is typically a better forecaster of upcoming economic conditions versus the equity market. So still not completely out in the clear at all yet, as indicated by bond market volatility. And put call ratio is super low here at 0.84%. So again, not a whole lot of fear in this market. However, we do have that skew ticking up again to 134, so it appears some people are buying out of the money put options as a tail risk hedge. And it's looking like breadth may have topped out here. The amount of stocks above the 20-day average at 76%, and that's come off there today and is starting to form a little breadth divergence with the market. The market's moved a little bit higher since here and the breadth is coming off. And we can see that in the 200-day as well, stalling out around here, around 56%. And ETFs making new high, came off only 38 today. 35 on the NYSE, and 34 stocks made new highs on the NASDAQ today. So the breadth is just not there for the market to rip higher. Spreads a little mixed today. Growth sectors just up a little bit, but still under their 50. Equal weight still really flat against SP. High beta still under its 50 versus low volatility. And growth value still trying to hang on to its uptrend here. The same as NASDAQ versus SP as well, getting close to its 50 bar. So I can imagine next week we might test this uptrend in the growth and tech stocks versus the main S&P 500. However, we've still got small caps trading really weak. Look at the Russell versus the SPY, approaching lows that we saw last week after that really horrible March, as the Russell has more of the smaller regional banks. And gold came off a little bit today versus stocks. However, if we go out to a weekly chart on the spread between gold and stocks, turn on our trend candles indicator, we can still see this is in an uptrend. It's been making higher highs, higher lows. And if we go out to a monthly chart, We can see that's been consolidating and basing for years now. So gold is still very cheap versus stocks, even though we've had a pretty good run in gold stocks lately. And just looking at a weekly chart of developed stocks versus American stocks, and that has gone into a bull trend as well. Same as Europe stocks versus SPY. They've been performing really well since September last year, actually. Yield curve pretty flat today. Saw a little bump up in high yield bonds and the 2-year. And so it looks like the bond market was really paying attention to bank earnings today as an input for where the Fed goes next. Because we saw that big move up in the 2-year today to 4.1%. And if I add the financial sector ETF onto this chart and just go down to a 4-hour time frame, you can see back here on the 9th of March, when the 2-year really sold off, that's when Silicon Valley Bank went under. So before that, the two weren't really tracking. But if you look at the XLF financial sector ETF, it's very much correlating the 2-year rate here today. So the bond market is paying close attention to the banking sector as the immediate biggest input for where rates go next. So for clues on rates are going next, we can look to the price action of the financials and the big banks. And I think that's why we saw today the banks move up, rates move up, but overall stocks came off a bit because stocks and tech stocks don't like higher rates, even though this is good for the banks. And we can see the 10-years bounced off the support zone pretty good now, reclaimed over 350. Fed fund futures look to have broken out as well after we consolidated for that last week. We're now above the 50 at 505 on the June contract. So all this fear and hard sell-off from the banking crisis and fears of contagion looks to have really subsided now, and the banks come out and said, no, it's all good. Like I was saying back here, if the contagion doesn't spread, there's no reason why we can't do a 50% retrace and get above our 50, and that looks like what to have happened. So it looks like we're moving back to this previous theme back here where the focus was on inflation and the Fed increasing rates to get on top of that. However, I don't think we'll rush right back up 540 anytime soon, since we have had those softer inflation prints come in and the little signs that the consumer could be starting to turn on retail sales and the higher jobs opening and some other jobs data. But at the end of the day, unemployment rate's still 3.5%, so Jay Powell has full permission to go ahead with rate hikes. Because in my opinion, he won't pause until that unemployment rate gets above 4%. More closer to 4.5%. And with that fear subsiding and rates jumping, we saw treasuries come off today and now testing their 50 as support. And the dollar looks to be attempting to hold as well on that with those higher rates. Still at this big support zone on the dollar index at 101. So this will be a big one I'll be watching next week. And Bitcoin sitting comfortably above 30,000. I think this may rip over the weekend. And surprisingly enough has held up even in the face of those higher rates today and fear subsiding in the banking sector. And that's initially what made it rip here back in March 10 when Silicon Valley Bank went under. So it'll be interesting to see if it can hold on to this uptrend or it's going to correlate to the fears in the banking sector, because if it goes high, it's kind of doing its own thing now. And Ethereum as well just broke through 2100 and on really strong price action here on good volume. Commodities were flat today. We saw a bit of a pullback in gold and silver, which is to be expected after we've had such a great run the last couple of weeks. Natty gas still trying to find a bottom down here. Over to stock sectors, pretty mixed out there today. A lot of them were flat. We saw biotech reverse its big move from yesterday. Gold miners came off a bit. The regionals came off, even though the big banks did really well. The big bank sector only didn't quite get up 1%, but is above its 50 here. And REITs came off 1.7%, now below their 50. And defensive sectors had a little bit of a pullback. There's healthcare, staples, and utilities. Over to popular stocks, so we saw BlackRock report today and they popped up really good above $700 a share, but did sell off in the afternoon and still finished the day up over 3% on good volume. So I normally use the price action of this stock as kind of a leading indicator for the market. However, I think the banks are starting to do their own thing, like we can see with the rates. So the banks are doing well is actually putting upward pressure on the rates, because the main reason the rate market came off was fears that the Fed was going to have to lower rates to help bail out the banks and the economy. But that looks to have all subsided now, so there's no reason that rates can't keep going up. And we can reverse all that fear in the banking sector, and generally higher rates are good for the banks as they can increase their net margins. And look at that price action in JP Morgan, really solid today. Huge gap up, held, finished near the highs, up over 7.5% on big volume. And according to our stock fair value indicator, it's still valued at $317 a share, so we're still 56% undervalued here. here. So with all that fear subsiding and JP Morgan actually gaining deposits and increasing its margins by having to pay less on its savings, charge more on its loans, rates still moving up, there's no reason JP Morgan can't break out in the next couple of weeks, but I don't think that means the whole market is going to break out as well. Tesla just sitting flat, came off a little bit. Same with Apple and Microsoft, kind of just stalling out the top of their resistance zones here. Google as well. Meta actually found new highs today, and NVDA just kind of holding there, consolidating. And Netflix came off a little bit. Meme stocks mostly red, except for Big Bear, actually found new highs today. So this AI hype train doesn't look to be over just yet. And the banks, Deutsche Bank back above its 50. So there was worries this was going to go the same way as Credit Suisse, but that doesn't look to be happening. But the vulnerable regionals, look at that. We have to put this on a log chart to actually see what's going on down here. This is super just flat. These are kind of technically already dead. First Republic, PacWest, and Western Alliance. Just trading really flat like a zombie. So I'm not sure if these things ever come back. But again, the big guys are fine. Look at this. We've got Bank of America back above its 50. It hasn't reported yet. Citigroup reported today, similar to JP Morgan, did really well. And they actually beat EPS by 32%, similar to JP Morgan, came in with really good EPS numbers. So the market's kind of like, what banking crisis, let's rip higher. Wells was a bit more subdued. They didn't put in as good numbers, only beat by 8.9%. And Schwab, I would have thought with that today we would have saw Schwab rally, but apparently the market still thinks there's going to be problems with Schwab, and they're reporting on Monday, so we'll be paying close attention to what they say and the subsequent price action on Schwab. Okay, that's a look at all the major market categories. Let's go back to the main indices. So even though we saw the positive news from the banks today and the price action, that was kind of really isolated to those banks and actually caused the rates to move up, which overall I think is a negative for this market. And just turning on the net liquidity model here, we got to an almost 200-point gap there today. And I'm seeing this little divergence on our hidden divergence indicator. And I think we're stalling out up this resistance zone here. And we just look at this SPY. And I'll just go to a 3-day chart for you. So I do think we're stalling out up here. And you can see that price action is kind of compressing. And we can see that in the realized volatility and implied volatility as well, which at these extreme levels I think is a good contrarian play. And looking at the equal weight S&P 500, that's kind of just really flat, trading sideways. And if you look at mid caps as well and small caps, really low, and micro caps look to almost be breaking out down to new lows. So the really sensitive small high beta stuff is trading super weak. It's just the mega cap tech that is holding up this market. But this NASDAQ's been on a good run all year and could be stalling out as well. So with fear and greed levels this high and we're stalling out resistance, volatility really low, and breadth kind of losing its legging, I've tilted my personal swing trading portfolio 20% net short again. Now we could still go up to 4,200 on the SP500 and maybe even go a little bit past it, as the market kind of likes to fake out a little bit. You can see last time we usually push a bit further than previous resistance on support, so I wouldn't be surprised if we even go up to 4,250. But I can imagine, unless the Fed balance sheet increases, I would still remain net short, maybe even get a little bit more net short if we move up towards 4,300. So the bigger the gap between price and this yellow line here, the fair value model, the more inclined I am to get more net short, as I'm still siding with the bond market that a recession is coming. And overall, that should be a bearish net negative for stocks. Okay, that's it for this week. I hope you guys had a great week. Thanks very much for tuning in. And if you found value in this video, hit that subscribe and notifications button, and I'll keep you updated every day on what's happening on the market and where I think prices could be going next. All right, guys, have a great weekend and see you Monday afternoon. Cheers.